Thank you very much, Murad. There are three groups I'd like to thank today before I begin my presentation. First, of course, our wonderful conference organizers and hosts, SteelOrbis and IREPAS, for their kind invitation and opportunity for me to present some of our views in front of you today. Secondly, I'd like to thank the esteemed panel that preceded my talk for their wonderful insights. I certainly learned something, and that at the end of the day is the goal of any researcher, is to always learn something new. And last but not least, I'd like to thank the taxi driver that brought me to the wrong hotel from the airport in Doha, and coincidentally provided me with a heavily discounted tour of this wonderful, bustling, growing city. Again, as a steel person, it makes me happy to see so many cranes. That means there's steel demand, and that's a good thing. So without further ado, I'd like to get into my presentation. Maybe a couple of quick words about World Steel Dynamics. My guess is most of you are familiar with a gentleman by the name Peter Marcus. He is the founder of World Steel Dynamics. In his day, he was a very prominent analyst on Wall Street covering the steel sector for many, many years, and along with his partner Carlos Kierses founded World Steel Dynamics in the early 1970s. And for the past 40 years, we've been dedicated to research in specifically the steel industry as market forecasters, industry analysts, in many different facets. So with that, I'm going to try to keep everyone awake. I know it's kind of that hour when everybody tends to go to sleep, so I'll speak fast, I'll speak loudly, and I'll hopefully speak provocatively. So, four things I'd like to discuss today. First and foremost, the outlook for steel demand growth globally in the medium and long term, and most importantly, within that context, the key drivers of steel demand globally, because at the end of the day, it's what drives steel demand that will determine the quantity of steel demand. The next subject is a very interesting one, of course, for anybody in the steel industry, especially the producers, and that's the subject of metallics. We as WSD, dubbed the last 5 to 7 year period as the steel's age of metallics, of high raw material prices, and the provocative question we'd like to ask and answer for you today is whether or not that age is over. Then I'd like to discuss a little bit, and this dovetails from the metallics discussion quite nicely, the global cost picture, production cost for a variety of items. In this case, we'll talk a little bit about liquid steel and billet, which is more near and dear to everybody's heart in this room, and discuss how cost dynamics may have played a role in the steel markets over the last couple of years, and certainly how they will continue to evolve as we look ahead and what that might mean for the steel industry structure. And then finally, I want to get into the subject of kind of an interesting and exciting development in the world of metallics once again that could really transform the landscape of the global steel industry. I think it's a very provocative subject, not in that you've never heard of it before. It's been quite widely discussed. I think it's mostly provocative at this point in time in terms of stimulating thought among the producers as to how they will allocate investment in the steel industry in the next few years, and what impact that might have on the industry structure a decade from now. So let's get into the first subject. Can't really talk about global steel demand without talking about China, because as this chart points out, especially with the decline in steel output and steel demand in Europe over the past 2 years, China has been the growth in the steel industry on a net basis since 2007, and probably longer than that, but certainly from this point of view it has been. If you look at the sheer numbers, their production has risen about 240 million tons. Global production has risen about 240 million tons, 200 million tons. So in fact, they've helped offset some of the decline elsewhere on a net basis. Now, what drives steel demand specifically in China and frankly anywhere? Well, as this chart illustrates, fixed asset investment, or specifically gross fixed capital formation, is the key indicator and key driver of steel demand globally. Even in places like the United States, which are highly developed countries, perhaps intuitively far beyond the peak of their infrastructure build curve and so on and so forth, still about 75% of steel demand is tied directly to gross fixed capital formation or fixed asset investment in that part of the world, which leaves only about 25%, or in China's case less than 10%, for consumption. Now, what's consumption? What do we think of in terms of steel consumption? Well, it's automotive, appliance would probably be the two biggest items. So again, gross fixed capital formation is the name of the game, and no place else in the world has it played a more prominent role than in China. And just maybe I skipped ahead a little bit too much. What do these slides show? Well, this is just simply numerical proof of our theories. We're looking at global fixed asset investment versus apparent demand. Clearly, you can see the two lines move together quite nicely. In the advanced economies, what's interesting is the recent sort of coupling. It wasn't quite as well correlated in the past. But if you look since the crisis, it's been recoupled again. Our theory is it's a lot of the infrastructure projects that have been announced, even in countries like the United States, have once again sort of brought the two phenomena closer together. You look at the developing world, ex-China, the picture is clear, and of course in China, once again, it speaks for itself. Now, another concept that we're sort of big believers in is what we call the fixed asset investment flywheel. Well, what does that mean? Essentially, our theory is that something like maybe 10 to 20% of steel demand in a given period, let's take a quarter, is directly tied to the investment in that same quarter, to the money deployed in that same quarter, let's say. Therefore, the remaining 80 to 90% of steel demand in that given period is a function of fixed asset investment in prior quarters, so it's money that's been spent before. So all we're simply trying to illustrate here is there's a certain lag between investment and steel demand, which helps explain why, for example, some of the demand momentum might carry over in China for several quarters, even though you see things like, you see new loans pull back, you see, as we heard today in one of the big news events this morning that I was reading about is another pullback in the Chinese stock market on the news that the government is increasing restrictions on property investment once again. So you hear news like that, yet at the same time there's quite a bit of optimism in China at the moment about steel output for the next quarter or two, simply because everybody recognizes the record amount of investment that's occurred in December and in the second half of 2012, and expecting that to trickle into the first half of 2013, combined with some of the seasonal phenomena that you typically observe in terms of a boom in construction in China. So again, a very good illustration of this fixed asset investment flywheel effect. Now, as we look out into the future, China, well, at the moment, gross fixed capital formation in China is running at about 50% of GDP. And you can see in, I don't know if this works or not, yep. In this column, you can see the evolution of that proportion to GDP. In 2011, topped out about, it was about 48%. And again, we estimate about 50% in 2012. How has this happened? Well, everybody understands the stimulus that China deployed in 2008 to counteract the slowdown of the global economy, the slowdown in the export growth. But what does it mean from a physical point of view? In our view, basically the stimulus that China deployed over that 2 to 3 year time period took steel demand from some period of time, let's say 5 to 10 years forward, and compressed it into a very short period of time. What does that mean for future steel demand growth in China? Well, again, if you take 10 years worth of demand and squeeze it into 3, set that as your base for growth, you're going to have a hard time delivering really strong growth figures for steel demand looking out ahead. Now, you have to combine that with another sort of phenomenon that's well understood in Chinese economic policy, and that's the desire of the Chinese government to slowly wean the economy off of this fixed asset investment or investment-driven growth machine. In fact, you know, what we estimate on a conservative basis is that gross fixed capital formation will decline over the next decade to maybe something like 40% of GDP, while consumption rises by a similar 10% in that same time period as a proportion of GDP. Well, what does that mean for steel demand? What we have to consider is the steel intensity of those two components of GDP. Fixed asset investment is by far more steel intensive than consumption. And again, we illustrated that earlier in this comparison between the US and China, and simply illustrating the proportion of steel demand that's attributable to consumption. So it's our belief that as the Chinese economy evolves away from the investment-driven, away from a higher proportion driven by fixed asset investment to a lower proportion, that will come in combination with a reduction of steel intensity in investment. Why? Well, you know, one theory, one perhaps practical example that one could use to illustrate it is maybe they'll be building, I don't know, fewer buildings and more data warehouses, for example. So you have a lot less steel going into a data warehouse. You're perhaps spending quite a few more dollars than you would in a residential building or something like that. So, you know, China has clearly done a magnificent job in many ways for this, of deploying this massive amount of capital into the system and creating quite a boom of steel demand in a short period of time. Now, as we look forward and wonder, okay, well, where else could another Chinese phenomenon occur? The one place that a lot of people, you know, tend to turn to as in hope of seeing another Chinese-style steel demand boom is India. Unfortunately, I would say India, as much potential as it has, is perhaps a classic example of minimizing potential as opposed to maximizing potential, which might have been the case in China. Why is that? Well, it has to do with many factors in India, one of which I would say is the political system. In my frank opinion, you know, perhaps India is a classic example of where democracy doesn't work for increasing the maximum utility of in optimizing sort of the economic benefit of the average person in a particular country or economy. Another reason is the structure of the Indian economy. Indian economy is primarily services driven, 65 to 70% services, about 30-35% fixed asset investment. So as a result, it's very difficult for India to replicate the type of growth rates in steel demand that China was has demonstrated. Never mind the political obstacles, and never mind the inability to implement, which is really tied to politics, as rapidly and efficiently as China has been able to implement its investment. So all this chart, you know, simply illustrates is, first of all, the wide disparity in steel demand between the two economies, despite the similar populations. And what we've done here is sort of illustrate, okay, had India figured it out, let's say, or for lack of a better word, had they been able to simply replicate the type of growth rate that that China had produced during this period, what the steel demand in India could have been versus what it actually has been. As you can see, as recently as 2011, you know, on a theoretical basis, steel demand could have been nearly double of what it actually was in India, had their economy behaved and been structured similar to the way the Chinese economy is structured. You know, another topic I want to discuss for a second. There are a lot of industry analysts and researchers that like to use the concept of per capita steel consumption as a means of forecasting what might happen in a given place around the world. It's an interesting concept. In theory, it applies. You would think that with a certain population, you would ultimately consume a certain amount of steel in a certain part of the world, all other things held equal. And largely that's true. However, what that measure is missing is the rate at which that steel consumption would occur. What I'm saying is this. As an engineer, you learn the concept of something called potential energy and kinetic energy. Okay? Well, per capita steel consumption is sort of the potential energy equivalent of steel demand. it represents the aggregate steel demand that a certain region or part of the world could ultimately consume. What it fails to represent, in my opinion, is the rate at which it would consume it, and that's a function of investment. So even though India has the same population as China, roughly, in theory, on paper, would therefore have the same potential for steel consumption. However, the reason that it doesn't consume as much steel as China is the rate of investment, which determines how much steel gets consumed in a given time period, a year, or whatever, however you want to measure that. So, having digested all of this, how do we see the future? Well, you know, the China story is a perilous one. I personally am a bit of a pessimist on China. I'm concerned that despite perhaps even growing fixed asset investment over the next couple of years, they may not be able to sustain significant growth or perhaps even any growth as we look at, you know, toward the end of this decade. Again, declining steel intensity of investment is one factor. I think you have to really begin to appreciate just, you know, and understand just how much of the future steel demand has been robbed during the stimulus period, and how much longer can the Chinese afford to sort of build a bubble that could inevitably burst. And do you really want to blow that bubble really large and then have a really massive explosion, or would you rather let it burst sooner than later and let the world economy digest it and perhaps move forward? So our rather conservative view on steel demand looking forward for China is about a 2% growth rate until 2025. I think the rest of the world, there are some bright spots. I would say this part of the world is certainly one of them. We're a bit skeptical that India can figure it out and truly meet the expectations that they've set for themselves, which are quite lofty. But nevertheless, one interesting thing I do want to point out in this analysis, that despite the rather pessimistic view that we take on steel demand growth in the next decade, an interesting thing pops out. Take a look at the bottom of this chart, and specifically the capacity utilization rate. If we look back, and I apologize, I'm just going to I have to jump all the way back to the beginning. Over the last 5 years, the utilization rate went from a pretty healthy 84% globally in 2007 when times were pretty good, declined to 80%, and there's of course a first half, second half phenomenon there in 2008. Clearly, you saw a massive decline in 2009. We know what happened to demand and pricing then. Then you had a big rebound in 2010. Things looked better. You had a little bit more of a rebound in 2011, and then you've kind of taken a step back this past year in 2012 and plateaued. That's one of the reasons, along with overcapacity, which is implied in this number, that 2012 was a rather difficult year in steel. Well, let's take that in context and look ahead. What we estimate crudely for 2013 is roughly about the same capacity utilization rate, maybe slightly better. As a result, I think the sentiment that was voiced from the panel earlier this afternoon is perhaps fairly accurate. Things will be just a little bit better than last year, maybe about the same. And certainly from the point of view of supply-demand as measured by utilization rates, the numbers imply that. As we look ahead to next year, you see a slight improvement, about 82% capacity utilization, and that again assumes a pretty healthy rise in Chinese steel capacity. Again, a rise in Chinese steel capacity, not a decline in Chinese steel overcapacity, which everyone is acutely aware of. The same story applies to 2015. And what's interesting is come 2017, again, on the basis of these rather conservative growth assumptions for steel demand, we reach a quite unhealthy and perhaps even unprecedentedly high capacity utilization rate. And what's the risk here, I would say? Well, the risk might actually be to the upside to some degree, because I think today's environment is most likely not stimulating a tremendous amount of investment in steel capacity. It's probably, all things equal, forcing a few folks to take a pause and reconsider some of the investment that was slated. So if some of that mentality doesn't turn around in the next year or two, and people don't begin to invest once again in capacity outside of China, again, if these growth assumptions have any merit, in a few years, things could once again, unexpectedly to some degree from the point of view where we sit today, look substantially better than I think most folks are anticipating, other than the traditional optimism that everybody has that as time goes on things will get better. Now, one last thing I wanted to mention regarding supply and demand, and that was mentioned earlier today. There was some discussion about oil prices and their relationship with steel prices. We're believers in general that a high oil price is good for steel for the simple reason that a high oil price generally tends to draw funds away from the developed world, which is generally speaking not oil rich, into the developing world, which as a generality is oil rich. And those funds in the developing world tend to be deployed more as fixed asset investment or in the form of investment, as opposed to, had they remained in the developed world, end up making their way into the economy in the form of consumption, which is considerably less steel intensive. So all things equal, high oil prices are good for steel demand. And one thing I would suggest is, simply saying that the oil price is going to predict the level of steel demand is a little bit of a misconception, because one has to look at partly what is behind the high oil price itself. And again, the price is determined by supply and demand for oil, and there's a demand side of that equation, which is in some degree a circular function of the same fixed asset investment flywheel that I talked about earlier. What I'm suggesting is as the news headline in the Financial Times this morning stated, China becoming the largest importer of oil is a reflection of what's happened in China, which is a function of fixed asset investment in China. And therefore, what's the chicken, what's the egg, I guess. And what I'm suggesting is perhaps the Chinese fixed asset investment is as much a driver of oil price as oil prices are a driver of steel demand. Okay, moving on to the next subject, metallics. Well, again, we can't really talk metallics without China. I think this is a wonderful chart because it really puts into context how the industry has evolved in such a short period, only a decade, structurally. As you look on the left side, you see integrated production broken out into three parts of the world: China, the advanced economies, and the developing world. It's pretty apparent that nothing has happened in the developed world or advanced economies. Relatively little, although on a percentage basis, I guess it's pretty significant, has happened in the developing world. But really the whole story is China and their massive, massive increases in integrated steel capacity. What has that meant for the key metallic in integrated steelmaking, iron ore? Well, we've seen about a 700 million ton rise in demand, of which China is about 95%, 670 million tons of that incremental ore demand since 2003 as a result of China's hunger for that metallic. Now, based on the same production and demand figures that I presented earlier, we estimate about a 500 million ton rise in ore demand in the next 8 years. Well, what does that mean, and let me digress for a second. This just simply shows the breakdown. Where has China been getting its iron ore? I think most people in this room would recognize that the bulk of it has been via imports, although the Chinese are investing an astounding amount of money actually in domestic iron ore production, something like $20 billion annually. The unfortunate reality in China is most of the crude ore that's available in China is fairly low iron content, on average about 20–22%. So it requires a lot of downstream processing, beneficiating. The higher quality ores tend to be underground in underground mines, and those are considerably costlier to exploit. Hence, as history demonstrates, the bulk of the iron ore requirement growth in China has come via imports. What has that meant for pricing? Well, I think these charts sort of speak for themselves. The trajectory has been pretty steep in terms of pricing. We've seen pricing pull back in 2012 as Chinese steel demand growth slowed and the requirement for imported ore temporarily slowed. Looking ahead, I think the implication is clear. Although again, we calculate about 500 million tons of additional iron ore requirement by the end of the decade. Now, what can we expect out of price? Well, again, you can't look at price without studying both sides of the supply-demand equation, and this is a very interesting analysis that covers the supply side of the equation. So these projects, this is a kind of a roll-up from the United Nations report. There's a body called UNCTAD at the United Nations chartered with tracking investment in iron ore on a global basis, and they report everything at a project level. And what we've done here is just roll up the different projects based on their status as reported by UNCTAD. And I think the status kind of speaks for itself. There's the under construction, conceptual, operating, expansion planned, so that's an existing mine planned for expansion, and closed with some reopened plans potential. Those are kind of negligible. So if you look at the sum total of these two just for the next 2 years, that adds up to a 500 million ton figure in the next 2 years, and we're expecting aggregate demand to rise 500 million tons in the next 8 years. So as a result, we're quite bearish on the outlook for iron ore prices in the medium term, despite what one might observe today with the price sitting at about $150 a ton. As some of these rather massive projects start to come online, especially from those projects that are already under construction. I mean, the runaway train adds up to about 200 million tons, again, according to this chart, just in the next 2 years. And that's certainly, we don't expect to represent, to be offset by a similar rise in demand in that same time period. So there's sort of an inevitability in our view of a much lower iron ore price not too long from now. Looking at the Chinese domestic production, a lot of people point to Chinese domestic iron ore production as sort of what will save the iron ore price because the cost to produce iron ore in China is so high. It is high, but it's quite high at the tail end of the cost curve. And based on our research, that tail end of the cost curve, the quantity of iron ore in China that might be above, let's say, $95 or $100 a ton, might only be about 100 million tons to 75 million tons. So it doesn't take a whole lot to overcome that tail, so to speak, before the price starts to gradually decline, especially the sharpest portion of that tail that represents the price above, let's say, $110 a ton or so. As you look at the global iron ore production cost, again, you see that the bulk of iron ore production globally, about 1.1 billion of the 1.3 billion, is well below $80 a ton. Another powerful reason is some of these new projects, which tend to correspond to these, to the same parts of the world where production costs look more like this rather than like this. Another powerful reason to believe that the iron ore price is not likely to sustain at current levels or anywhere near what we've seen in the past 3 to 5 years. Now, lower raw material prices, in theory, in the future, what could they mean to production costs, and what does that really mean in terms of the competitive structure of the industry? So we can't really talk about that without really delving into some of the regional dynamics of production costs. So what I have here is a depiction of typical production cost for liquid pig iron or hot metal in different parts of the world. The competitive landscape in steel production boils down to really the haves and the have-nots. Those that have their own raw materials and in theory transfer price them at cost or however they end up booking the profit, and those that don't. India is actually a really interesting example. They, in theory, have some of the lowest costs in the world, despite a rather substantial dependence on imported coking coal. So really, of the two key ingredients in integrated steel production, coking coal and iron ore, they're extremely rich in one and rather poor in the other, and despite that, still end up one of the lowest cost regions in the world, if not the lowest cost. The CIS, Russia, Ukraine, is perhaps the second lowest. They tend to be doing pretty well in both facets, both iron ore and coking coal, although their iron ore costs might be a little bit higher because, again, the crude ore there tends to be of a lower quality. It requires some additional processing and beneficiation. And then you have parts of the world like, South Korea and Japan, which is entirely dependent on imported materials, and their costs basically ebb and flow with the spot markets for these two commodities. Now, what's interesting is another region in the world that has long been believed to be one of the lowest costs, Latin America, specifically Brazil, is really not in that same position any longer in our view. Few producers are vertically integrated into iron ore anymore, and certainly the new capacities that are coming online are typically as either a joint venture partnership with an existing mining company, for example, in which case really the iron ore makes its way to the steel plant at market prices, or it's simply a steel plant built that's relying upon market price sources of iron ore. Now, in addition to that, Brazilians are largely entirely dependent on imported coking coal. And the charcoal-based production in Brazil tends to support smaller merchant pig iron blast furnaces. It's somewhat difficult to scale that technology to a substantial level. So Brazil is an interesting place despite a pretty healthy potential for steel demand growth in the medium and long term. There's some questions regarding investment in additional steelmaking capacity in Brazil, in our view, on the basis of rising production costs, inflation, and other country-related risks, along with rising labor and energy costs. So what has all of that meant for the evolution of cost over the last few years? Well, what we show you here is sort of three snapshots. Back in April of 2011, that was probably the last time when the coking coal price on the spot market or on a quarterly basis and the iron ore price converged somewhere near the astronomical highs that they had reached over the past 3 to 5 years. And you can see the incredible steepness in the cost curve between the front and the back, with the difference between the median producer in sort of the first quadrant of the cost curve and the fourth quadrant, the highest cost quadrant of the cost curve, north of $200 a ton on a liquid steel basis. So this doesn't include the conversion costs to a semi-finished product like billet or slab and then downstream. Now, as time has gone on, you see this cost curve has flattened substantially. So we've gone from $214 a ton on a liquid steel basis to only about $117 a ton. Well, combine that flattening of the cost curve with a basically stagnant or slightly lower utilization rate like we've had in 2012, and you have a classic example of increased competition in basic commodities industry like steel. What does that mean for pricing? Well, as the difference between the haves and the have-nots sort of gradually declines, the stimulus for the high-cost producer to cut back output when demand is weak declines. They want to hang on. They want to keep producing, wait out demand, and hope for an upturn. In an environment where they're $200 less competitive than the best cost producer, all things equal, you're more likely to pull back sooner than you would in an environment where you're only $100 behind sort of the best cost producer. And this encompasses the whole world. So on a regional basis, these disparities might be a lot less. So again, it keeps the high cost producers producing longer in difficult times, which essentially promotes more competition on a pricing basis, not in a direct sense because price ultimately is determined by supply and demand, but what it does is it sets the floor for price a lot lower. It dictates that producers will be willing to go lower in price just to sustain operating rates. And that's especially true among integrated steel makers for whom the fixed costs are higher, so the stimulus to sustain a higher operating rate is much greater. Outside of China, basically, the picture is about the same. The spread is a little bit less, 216 to 129. In China, believe it or not, the industry is also extremely varied. You do have quite a few mills that are fully integrated into iron ore. Coking coal in China, and coke especially in China, is quite cheap compared to the rest of the world. In fact, generally speaking, there's a massive overcapacity of coke production in China. Profit margins are very thin for merchant coke producers, and as a result, the Chinese steelmakers enjoy quite a benefit from that. So not all mills in China are built equal in terms of cost. Those that have their own ore, basically have the same advantage that those outside of China do. They're quite a bit better off from a cost point of view. On a billet basis, we've just introduced our billet wire rod cost curve last December. So we just took the last monthly snapshot a few days ago, in fact, in February. And you can see the cost curve has moved up a little bit. That reflects the rise in the iron ore price, the rise in scrap prices in some parts of the world, a decline in scrap prices in other parts of the world. So there's been some very interesting dynamic shifts in the cost picture for billet just in the span of 2.5 months. Not so much outside of China as it has been in China. Again, that's the iron ore price being reflected. Now, let's talk about another phenomenon that may or may not happen in the sort of medium and long term, and that's the story with Chinese scrap. Now, this analysis is based on our what we call global metallics balance model. It's a very detailed, rigorous model that delves into the consumption of all the key steel makers' raw materials on a global basis, country by country, with a projection out to a decade from now to 2025. And the basic thrust is to have a very good understanding of what one can expect in the raw materials world based on a certain steel production outlook and steel demand outlook. So what do we find as we first of all look at history? Well, as global steel demand has gone up, the requirement for obsolete scrap has risen accordingly. In fact, the most important component of this is the obsolete scrap requirement. What does that mean? Well, basically you have 3 different types of scrap. Home scrap is the yield loss in the steel mill. Basically stays in the steel mill, ends up being converted in the next melt. So it doesn't play much of a role in supply, demand, or pricing dynamics. New scrap is the yield loss in immediate downstream manufacturing for the most part. So it's your automotive stamping yield loss, appliance yield loss, construction, rebar yield loss. This type of scrap tends to make its way back again to the steel producer, especially in the developed world, quite quickly and readily, and again is largely a function of steel demand and doesn't really play a large role, let's say, in the determination of pricing. Now, the most important component is obsolete steel scrap. That's the stuff that's collected. Its collection is largely a function of price, which in turn is a function of demand. And these are the dynamics that are really most important with respect to understanding the future of steel scrap. So what else have we observed? Well, as you look at the relationship between obsolete scrap demand and price, it's a pretty clear-cut one. This picture doesn't show that, but the reality is there's about a 90% correlation on an annual basis between total demand, aggregate demand for obsolete steel scrap globally, and pricing. What does that mean? Well, as we look forward, it's pretty easy to calculate what we think demand for steel scrap will be on the basis of our steel demand forecast and steel production forecast. And it's not too hard to calculate what the reservoir or availability of scrap might be, because that simply is a function of steel demand in the past. So the stuff that was consumed as cars, appliances, even bridges, roads, houses, and so on, becomes scrap sometime 10 to 40 years later, depending on the life cycle of that individual item. So one simply has to look back for the last, several decades at what steel demand is in certain parts of the world, and you can come up with a pretty good estimate of what the available supply of scrap might be as you look forward. Well, that's really the interesting thing, the interesting discovery with respect to China. If you look at just this past year, Chinese obsolete scrap demand was about 62 million tons. Okay, not a particularly high figure. Again, they produced 720 million tons of crude steel. 93% of it was integrated base, so you only have a small component of EAF-based steel making. And on top of it, the Chinese tend to charge a relatively lower proportion of steel scrap in their BOF, basic oxygen furnaces, compared to the advanced world where you might have 20 to 25% of the BOF charge as scrap. The Chinese tend to use on average about 14–15%. So that demand figure isn't particularly striking. Now, as we look out to 2025, based on, again, this rather conservative 2% steel demand and production growth outlook, that figure only grows to about 80 million tons. However, what's happening to supply? Well, as you can see, at the moment, China is about in balance. They're a slight net importer of steel scrap. However, as we look out about a decade, as a function of this massive steel demand growth that we've seen over the last 20 years in China, we calculate a rise in that steel scrap availability or reservoir to about 220 million tons from today's 57 million ton figure. So that's about 150 million tons of steel scrap in China in about 10 years that doesn't, in theory, exist today. Now, what could change between now and then that would cut some of that surplus out of the market? Well, one thing that can happen is this scrap charge in the BOF. This proportion that I mentioned is somewhat below the typical rate in the advanced world. In China at about 14 to 15%, could go up to about, let's say, 20%. Well, what that would do is raise their own domestic requirement from about 62 to 116 million tons. So that's a pretty significant figure. What else could happen? And this certainly is I would say, a likely scenario. Much of it will be a function of the energy outlook in China, but they could also seek to increase the proportion of steel that's made via the EAF. And that certainly would dovetail with the overall desire by the Chinese government, as stated in the 12th five-year plan, to improve the pollution situation in the country. And I think certainly the steel industry is a large contributor to that, perhaps not as much as most people would think, but nevertheless, a rise a fairly moderate rise of 8% in EAF steel making as a proportion of the total would again result in a pretty hefty rise in obsolete scrap demand. So when you put those two together, you could probably cut that excess of Chinese scrap in half, from 150 million tons to about 70 million tons. Nevertheless, you have 70 million tons per year of excess scrap coming out of China. To put it into context, the United States, which is the largest exporter of steel scrap in the world today, exports about 18 to 20 million tons a year over the last couple of years. So that's still quite a massive figure. Now, coming back to industry structure. Now, if this is really true, okay, if you can kind of take these numbers, take these calculations and book them, what does that mean for the world? What does it mean for capacity investment today? What does it imply should be happening in today's world? Well, there are a couple of things that need to be considered. There's a wild card here. What's China going to do with this scrap, assuming it becomes available? Will they allow it to flow to the rest of the world unimpinged, or will they put an export duty on steel scrap, essentially trapping it in the country? Well, let's take the latter example. Suppose they put an export duty on steel scrap. You'll have, an inherent oversupply in the country. You'll probably have prices that are well below market prices elsewhere in the world, similar to the situation you might have, I don't know, in South Africa, Brazil, other parts, Argentina, where you have rather steep export duties on steel scrap, which will stimulate a reconfiguration of the industry domestically, probably help that 12% EAF go to 20, help that 14% steel scrap and the BOF go to 20, 25% pretty quickly. Conversely, what does it mean for the world outside of China? Well, it means China will need a whole lot less iron ore and coking coal than it would have otherwise. What that means is, of course, that excess iron ore and coking coal makes its way becomes available, probably again at a lower cost than it would have otherwise, to the rest of the world. But who's going to be ready with those blast furnaces to take advantage of that massive oversupply of cheap iron ore and coking coal? You know, I think that's certainly an important question, because as all of you know, the lead times in integrated steel capacity build outside of China are certainly quite significant. So unless we find, you know, big believers in integrated steelmaking capacity outside of China soon, we could find ourselves actually in a shortage for pig iron production only a decade from now. Now, the other scenario, of course, implies somewhat of the opposite. If steel scrap starts to flow in massive quantities out of China, then those with electric arc furnaces will benefit and find, you know, a massive oversupply of steel scrap on the open market, and therefore find themselves perhaps at a temporary cost advantage to the integrated producers until, you know, a whole lot of money starts to flow into more and more EAF-based steelmaking, and the cost curve becomes flatter once more. I had another point that I wanted to make, but frankly I lost it. So with that, I'm going to end my presentation. I hope all of you were able to sort of keep up and I didn't speak too fast. But before I take all of your questions, I have a question for the audience. I know there's quite a few of you here that are in the trading business in the region. In fact, quite a few of you here are from Turkey specifically. So the question I have is related to the Turkish steel industry. What I don't know, and I'm really trying to genuinely understand, and pardon my ignorance, is how do Turkish steel producers manage to buy U.S. steel scrap, ship it to Turkey, convert it to rebar with one of the world's highest electricity rates, and then sell it back to the United States and be the largest exporter or importer, however you want to look at it, of rebar into the United States? Meanwhile, capacity utilization rates in the United States for the same product might be, I don't know, 50, 60% at best at the moment. So if any of you can enlighten me to the various ingredients that make up this massive puzzle in my head, I would love to hear some answers. And with that, of course, I'm more than happy to answer some questions also. No takers for my question. I think there's a question up here. Yeah, I guess they must not have made it into the room, so. Okay.
Well, perhaps they're producing really very cost effectively, I guess, right? This has always been the million-dollar question, right? Million-dollar question. Well, how do Turkish steel mills do import the scrap all the way from the States and then export the rebars back to the States? Of course, there's some sort of trade secret in that, but it's definitely not state incentive subsidies or something like that.
Not that I'm aware of.
Yes, it's.
So,
I think they got it.
Phil, the inlet costs to move scrap are more expensive than the sea cost to move scrap. So let's say $30. to move scrap from the United States East Coast to Turkey.
Okay.
It costs more than $30 to move the scrap from the local scrap supplier to the U.S. mill. So already 1-to-1, the USA is more expensive. The next is the availability of the ocean freight to bring the steel back to the customer. Same, you have these consequences where it's much more expensive to ship by truck than it is to ship by ocean vessel. But ultimately, the domestic mills in the United States hold a specific advantage. So not only is Turkey not getting the full price that the domestic mills are getting, the domestic mills have an advantage through the Buy America program, and that allows their steel to always command a premium because its ability to be used in federal or state highway jobs where Turkey is not. So I think we must commend the Turkish producers for their efficiency, but also take a second look at the domestic mills as far as their profitability and how different that is. So the Turks are working for basically nothing, and the domestic mills are complaining when they're the ones making all the profit.
Okay. Well, I think your last 2 points were particularly enlightening to me. I'm not sure I agree with the first one too much, because as I look at at least the reported prices for steel scrap in the United States, for the domestic mills, they're reported on a delivered basis. For the export markets, they're reported FOB port of export, and in general, I believe the price FOB port of export is basically at parity, maybe a little bit of a premium in the U.S. So on the outbound component, I don't know that I fully understand your point, but we can take that offline. It's interesting what you point out about the truck freight versus the the ocean freight back from Turkey. It's interesting. I guess a lot of the mills in the U.S. tend to be the mini mills. They, in theory, should be near their end-use markets. So it's kind of mind-boggling that I guess our trucking rates are so high. But certainly the profitability question answer that you've given is enlightening, and perhaps the way that the U.S. mills approach profit maximization versus their Turkish counterparts.
But I just don't understand why you're wondering this, because this was the question kept being asked for the last 20 years, and I was trying to answer it 20 years ago, but I see no reason to answer it anymore.
Oh boy. Made the podium fall apart.
Well, there's no question, though. I mean, the issue was whether this was sustainable or not. And if the Turks are capable of doing it for the last 20 years, it means sustainable. So let them do it. Yes, right, we're doing it with no money when the time comes. Maybe we just make money for a year and spend it for the next 5 years.
Well, in all honesty, my question was about sustainability.
What Philip was saying, yes, it's right. I mean, if you look at the cost, there are advantages for the U.S. mills and there are advantages for the Turkish mills. What are the pros and cons? I mean, Turks, for example, the main strength is the marketing capability. Today, anybody who's looking for rebars from a third country, Turkey is the #1 source, comes into their mind. So whomever wants to buy rebars, that's the first address they go. So that was, I believe, the main strength in Turkey has developed. From Australia all the way to Chile, I believe there are almost over 100 countries that Turkish rebar has been landed. So I guess let's put that thing over. That's should be considered as the know-how the Turks have.
Very good.
Thank you.
Let me
There's another question
to Mr. Adel. He wants to add some comments here.
Yeah, thank you. I think I'm not the right person to interfere in such important question, which is like what Mr. Orr said. It has been asked since a very long time, but they can answer it better than us. But in behalf of the Turkish, I remember I heard this question precisely. It was asked before 1 month, just 1 month ago. In Istanbul, we had a gathering there, and I think it's asked by Mr. Peter, your colleague from SteelOrbis, to the same people, to the Turkish, how you are succeeding in making profit with this competition. Different question, but the same philosophy. And one of the Turkish expert people answered the question, and I think it's not a matter of calculation that you can say 1 + 1 is equal to 2, then you will win, or 1 - 1 is equal to 0, then you will lose. he said simply, it's a matter of people anxious, manning power strength. Otherwise, the steel should be produced only on Australia and Brazil. I think I heard this question since years. I think this is the best answer, at least to my understanding, which is means something. Right. Thank you.
Thank you very much. Sandeep?
I have a different question, nothing to do with this, but it does impact on Turkish producers, and I think also most of the producers here are EAF based. So you talked about the scrap availability in China, the reservoir which is going to build up in China. What about the rest of the global reservoir? Do you see an imbalance there? Do you see any shortages, or do you see excess supply?
The answer is pretty simple, actually. Again, because the reservoir is a function of steel demand, all you have to do is kind of think back to what's steel demand been like in the last 20 years, for example, in the advanced world. It's been largely stagnant. It's grown at an average rate of maybe 1 to 2%, let's say. As a result, the reservoir in that part of the world will continue to grow at about that same rate. However, that part of the world is also, it's really the feeding trough, so to speak, for scrap for everyone else at the moment, which is in the opposite situation, where steel demand is rising faster than the reservoir. So they serve as the largest exporters of steel scrap to the rest of the world. So what essentially happens as you look out ahead is the reservoir continues to grow very slowly, and in fact at some point in time will completely plateau to reflect what's happened to steel demand in the past decade, essentially. And as a result, the pinch in that part of the world will become greater and greater. Okay.
Thanks. Michael Sotterdal has a question here.
Thank you for making all these forecasts. I'm over here. Philip?
Oh, I'm sorry. Couldn't.
Yeah.
Dude, I have these bright lights in my eyes. I can only see in the back, actually.
That you've been discussing blast furnace origin or scrap origin. But however, we're in Qatar, and here we have a DRI origin material. DRI production needs pellets, natural gas, and no coal. So I would imagine that over the next 5 years, if we have this tremendous development in shale gas, that we'll be seeing a shift in this production cost scenario. And your comments about that, are you starting to put those into your
it's a very popular question at the moment, I would say. And I would say the answer to it is a lot more complicated than the obvious. I think all things equal, yes, cheap natural gas in the United States or any other part of the world where it's available will continue to be a stimulus for additional capacity investment in DRI. If that hadn't been the case, you'd probably have less DRI capacity built. But it's a complicated story. First of all, DRI has different value and use characteristics from scrap and from pig iron, okay, or hot metal. So even though on paper the price is substantially lower, let's say, than merchant pig iron, that reflects the value and use characteristics. So at the same time, the same equation plays on the cost side, okay? So unless you also have a captive source of iron ore, for example, DRI production might not always leave you on a better cost footing than doing the same thing, than producing merchant pig iron or hot metal in a blast furnace, for example. If you have, because blast furnaces tend to be larger and more efficient at full capacity also. DRI units are typically built in 1 to 1.5 million ton batches or capacity batches. So in order to replicate a 3 million ton blast furnace, you need two of these units. So your capital costs are still a little bit higher than you would expect, perhaps. But I think in the U.S. the situation is a little trickier because you have almost a no-growth environment. Okay, so before you really start to envision a massive boom in DRI production in the U.S., you have to consider what's the capacity utilization rate today, and it's sitting at about 75%. Okay, and so that means there's existing facilities that are either idled or abandoned altogether that could be reconstituted at what is most likely to be a much lower cost than investing in brand new DRI capacity. So that's one component. And the U.S. happens to be coking coal rich, so the price of coking coal for domestic producers tends to be a little bit below what the spot prices are in the merchant market. You also have a lot of imports of merchant DRI and pig iron into the U.S. So some of the capacity that will eventually be built and is already being built, for example, by one major producer in the United States, is really meant to offset their import requirements and not necessarily replace any existing blast furnace capacity or anything of that nature. So right now it's a gain in DRI production in the USA, one part of the world, but on a net basis it's a subtraction of capacity utilization in DRI or merchant pig iron somewhere else in the world. So it's not necessarily a net gain for the global industry. So the answer is a little more complicated, but I think overall we do believe that, and we forecast that DRI production in parts of the world that have fairly low natural gas prices will rise in the years ahead, and it'll become an increasingly more popular source of metallics for steel makers.
Thank you. Any other questions for Phil? Cannot see anybody.
Well, thank you all for sticking around at this late hour and asking such provocative and wonderful questions.